Markets steadying this morning after a blockbuster rally last week. Some traders optimistic that the central banks may start cutting interest rates in the new year. Our guest says we'll have to wait out an extended pause first, but give it time. Meanwhile, he says gold is looking attractive. We're joined by Eric Green, portfolio manager at Authentic Asset Management. It's great to see you.
Always good to be here.
You say don't be betting on rate cuts anytime soon?
Well, I do think rate cuts are coming. I think the market has made the right sort of adjustment over the last 3 to 6 months in terms of the depth of those rate cuts. But really, it's first things first. We just came off of a quarter of growth that was, it shocked me. I think it shocked a lot of people.
In the U.S.
In the U.S., yeah. And so I think at this point, the Fed can afford to stay hawkish right now just because of what they're seeing. Unemployment rate is still under 4%. But last week's rally, is a function of so many different things coming to bear. One of them was the actual refunding announcement coming out of the U.S. Treasury, which they were borrowing less. So looking a little more of a benign fiscal picture there at the margin anyway. So that gave scope for a little rally in terms of the long end. And don't forget, there's been no natural buyers in U.S. debt over the last several months. The Fed is gone. If you look at foreign central banks, they haven't been buying. The banks aren't buying U.S. debt anymore. And, of course, the hedge funds are just coming off of a massive short position, record speculative short position. I think that fueled some of the downdraft that we saw last week. But the Fed...
a short position in U.S. bonds.
Yes.
Right.
Yeah.
And so that led to a rebound.
Well, it sort of fueled, I think, that the scope of the decline in rates last week, which fueled some of the animal spirits in terms of the stock market. And you had the FOMC that was pretty benign. We were in an oversold area anyway. And if you look at also the unit labor cost data, I'm old enough to remember back in the 90s when Alan Greenspan, that's all he focused on. It was very benign sort of pictures. And so I think all of these things together put, oversold conditions, let's rally the market a little bit. But my big question, in fact, and we were just talking about this right before going on air, was now what? Now what do you do? That's the big question.
Where do you see equity? You're tocautious on equities, or relatively cautious. You don't think people should go gangbusters into stocks?
No. When I look at the market right now, Andy, I think, this makes a lot of sense in terms of where we are over the past week, even though it was a massive rally. But at the end of the day, the fundamental reality hasn't changed. The Fed is still shedding duration. You still have an economy that, while it has really surprised to the upside, the data is going to be even more important going forward, because now a lot of the factors that have been supporting growth and surprising growth to the upside over the course of this year are fading. If you look at the massive decline in savings rates, so the COVID surplus, that story's already played out. Fiscal stimulus, that story is close to playing out. And so I asked myself, well, where's the growth going to come from next year? So I'm looking at the high frequency data, and it's showing, well, this slowdown is very, very much in place. And you saw that in the October jobs report as well.
Yeah, Wall Street Journal reports today that companies, far from scrambling to get workers, are now wondering, how can we get rid of them? How can we cut our workforce?
Yeah, it's really interesting how these things evolve, because there was such high demand for labor, and the growth has been strong. So the first response, of course, is, well, we'll cut the work week, see how things evolve. The next step is going to be, they're going to be shedding workers. And I think that's what is going to be happening really over the next 3 to 6 months. So when you think in terms of rate cuts, you still have a couple of problems that the Fed is facing. Number one is that inflation is still too high. And I think that they're going to be slower than most people expect in terms of cutting rates. I think in the second half of next year looks very reasonable.
Second half of next year
Second
for a
half
cut.
of next year, yeah. So that's a positive. But in the meantime, the market is wishing, I want low rates, I want low rates. Well, you have to pay a price for those lower rates, and that price is going to come in lower earnings. So if you look at the earnings profile for next year, I still think, the same theme is that it's still just too high, right? And so I think that you're going to be, a downward adjustment in terms of the earnings profile at a time when, what you're seeing for central banks ain't going to be quite enough to get you really excited. So this rally is nice to see, and I hate to be the bearer of bad news, but from where I sit, I just don't see any justification to chase it. And frankly, there was a lot of technical damage done in the market last week.
In what way, sorry?
Well, in terms of 200-day moving averages, it cut through that like butter.
Going to the downside or upside?
Well, prior to last week, it just cruised. So I apologize. The week before that.
Okay, sure.
So this market, I think, is on thin ground at this point in time. So I would wait. If there's a ton of, I've never seen this much cash on the sidelines.
Oh,
that's a positive. But the question is, when do you want to put that cash to work? From where I sit, I'd rather not lose another 5 to 8%. And I think there's going to be much more attractive entry levels, I think, early next year.
The old soft landing. Every 4 years we watch the Olympics, we watch the gymnasts come off.
Right.
I guess we're hoping they'll stick the landing. Part of us hopes they'll fall over.
Right.
And you think a soft landing is kind of more of a hope than a strategy now?
Yeah, it's an interesting thing. I think people tend to be optimistic, and I think I'm certainly one of them, which is strange because I'm an economist by training as well. But I think that if you look back at the history of things, we rarely get a soft landing, right? And certainly when you look at the power of the tightening that's been going on in this cycle, it's the most in 40 years. And so I think that, soft landing is possible, but don't forget, soft landing views can change very quickly into something a little more nefarious. And that was the case in 2008. But hope springs eternal. But I'm not one of those who sees any evidence that a soft landing is the higher probability. So keep your powder dry. I really like a couple of trade ideas that sort of lean against this more bearish outlook, which is short credit, long gold. Gold is always a good part of the portfolio.
Well, tell us about that. Why do you like the look of gold right now?
Well, number one, I think that the Fed is sticking to its 2% inflation target, but at the end of the day, they're going to have to start cutting rates when inflation is going to be 2.5% to 3%. So with a wink and a nudge, what they're telling you basically is that we'll talk about the 2% inflation target, but we're prepared to accept something closer to 2.5% to 3%. That's good for gold. There's going to be ongoing strength in demand for gold from central banks because of this move to wean dependence off the dollar economy.
Because China is not apparently buying U.S. bonds in the way
they
it
are
used
buying
to.
you. And look, that's not going to change. You've seen it's not a positive dialogue in terms of a G2 type of universe. And when you look at the geopolitical risks that are percolating around the globe right now, it's always nice to have a little bit of that safe haven asset of gold. So I think that there's more upside to gold. It's outperformed every major commodity this year. It's up about 10%. I don't see that changing.
That's interesting. Yeah, gold flirting with $2,000 again. If the U.S. goes into a recession, is there any group of stocks, I guess yield stocks, utilities might be relatively stable?
Utilities have been hammered pretty lately just because of what we've been seeing on the rate side. But yes, so if you think in terms of what we've just been talking about, you want to be defensive, right? So things along those nature, staples, for example, as opposed to things that are less staple. But aerospace and defense, I mean, you're seeing massive calls for even more defense spending. So there's places to hide. There's places to hide, but I think that there's places to make money along the way. Short credit, getting long duration on the front end of the curve, and I like the U.S. over the Eurozone and other countries because I think that ultimately the U.S. will be able to cut rates faster than other areas. For example, in Europe, they're much more rigid in terms of their wage structures, in terms of their labor markets. So,
Eric, we've only got a few seconds. When you say short credit, what do you mean by that?
I think that if you look at credit spreads right now, they haven't moved much, but I think that when you go into next year, there's a lot of refinancing risks going on in terms of a higher rate environment, slower growth.
Sure.
That's going to compromise revenue. So I think that hasn't played out. So there's still an opportunity there. This is a trade that has a low beta to the market, but when things go a bit twirly, it has a very high beta, which can work to your advantage.
So junk bonds or even corporate bonds trading at too narrow a spread to government bonds.
I just think that there's going to be more juice there.
Eric, thank you.